Well, hi everyone. Yes, we're going over Paycom software this week because it's under our stock bust of the week group. But is there hope on Paycom? And let's see, folks. Paycom software is a provider of comprehensive cloud-based payroll and human capital management solutions delivered as a software as a service. Now, solutions cover the entire employee life cycle from hire to retire. And as of December of 2022, it had more than 36,000 employer clients, none of which accounted for more than 0.5% of revenues. It also had sales offices in 40 of the 50 largest metropolitan areas in the U.S., 6,350 employees. And notice that the chairman owns about almost 14% of the common stock. So that's a good sign right there. All right, now let's look at how Paycom has done over these are 5-year averages relative to the average stock in our entire database. So the blue lines are the average stock, and the green lines, the green vertical lines, are Paycom, or represent Paycom. So when we look at the return on equity, the clean surplus return on equity, we see more than 2 to 1. So that means this stock is going to outperform the S&P 500. Net income a little less than 2 to 1, but boy, it's still a big lead over the average stock out there. And remember, the 96% of professional money managers out there cannot outperform the S&P 500 over any rolling 10-year period, and that's a Morningstar report from 2002. And Paycom is leading in all aspects, and when we come to revenue, 3 times the revenue of the average stock, and that's very, very important. Now, remember these, well, you don't have to remember the numbers because I'll tell you again, but 23% for Paycom, 7.1% for the average stock. Now, what has been said, which caused the stock to drop, is that revenues will decline by about 6%. So that caused the stock to drop, what, 50, 60%? Yeah, that's quite a big difference there for a 6% drop in revenues, folks. But anyway, let's get on with this. All right, when we look at the yearly now, so we're looking at the clean surplus ROE, average stock 13%, clean surplus ROE almost 30% up here for 2024. And this number has been reduced, and we don't know if it's, you see, these are yearly numbers, and when the company comes out, it gives us quarterly numbers, and it doesn't give us the whole year's numbers. So those numbers, the yearly numbers, will still be coming out as we go along. But I want you to see 2019, because this is going to be important. 2019, it made $3.50 a share. For 2024, it's still projected to make $9.27, almost triple what it made in 2019. Why is this important? You'll see as we go along. But right now, I want to show you retention rate. Retention rate is how much of the money the company is making, putting it back into itself in order to grow. This company is taking everything it makes and putting it back into itself. Debt, well, this is the years to pay debt. If the company takes all the money it's making and uses it to pay off its debt, how many years will it take to pay off its debt? This is 1/10 of 1 year. In other words, in 1 month or 1.5 months, this company can pay off all its debt. So for practical purposes, it has no debt. So this company is looking strong. And when we look at 2024, these numbers are just about the average numbers. Now, we don't know if this 6% drop in revenue is included in this number. I don't think so. And that's for 2024. But we're looking at 2023 right now, and that's what they're talking about, 2023. So we'll just have to see how this plays out as we go along. But now let's look at how this company has done in the past 1 year. Black line's the S&P 500, and here's the yellow colored line here, and here it is all the way down here. This was the drop the other day. But you can see, evidently, word was leaking out that revenues were going to fall short, and the company started going down, and then all of a sudden, bam, the news came out, and it dropped down. So these are monthly units that we see here, or monthly divisions. Now, over the past 5 years, the stock was doing great, and then all of a sudden it dropped, and here it is right now, below the average stock in the S&P 500 over the past 5 years. But before that, it was doubling the S&P 500 over 5 years at about 100%, with the market up about 50%. Now, here's what I want to show you, which looks terrible. And here was this stock. These are the candlesticks. Stock was doing very, very well, and then it started falling. And see this right here? This is the 50-day moving average, blue line, 200-day moving average, red line. And when the 50-day crosses over to the downside, that's called the death cross. And boy, oh boy, it sure did die really quick. But is it holding in here? Is it going to hold? And it wants to. Now, this was on Thursday, and it rose nicely. And today is Friday that I'm recording this during the middle of the day, and it's down a couple of points. So we're seeing if it's going to hold this level in here. So let's go back to 5 years now. Okay, 2023, 22, 21, 20, and here's the 2019. Now, the word came out that this stock went down, and here it is right here. This stock went down to numbers it had not, or levels it had not been since 2019. So in 2019, this is where it was, and even if we look at an average price stock back then, it's really over a little bit, $200 a share. And right now it's down to about 150 something, 158 or so. Now, this is what I want to show you. Let's go back to this chart here. 2019, it was making $3.50. So the price is down lower than it was in 2019. For 2024, it's expected to make over $9 a share. So we're looking at 2.5 times more than it was making in 2019. So again, looking at 2023 and 2024, expected to make a little over $9. That's 3 times what it was making. Does the stock deserve to be priced down here as it was in 2019 if it's making 2.5 times what it was making back then? So that's how we're looking at this, that maybe this stock should be 3 or 4 times the price, or 3 times, 2.5 to 3 times what it was in 2019. So we're looking at this stock up here eventually making new highs, unless it continues to falter, unless there's something organically wrong in that stock, which we haven't heard about. They're just saying that revenues are slowing down. Well, the economy's slowing down, so yeah, revenues should slow down. But the market was expecting much more, and therefore during earnings season, if a company misses, and actually it didn't miss, it did okay. It just said what's going to happen in the future. And so this is all future stuff here, but it's real money in our pocketbooks, because we all own this, most of us own this stock, and therefore, but we expect it to be way back to its original highs again by the end of next year. So we think there's room to run for this stock. It just has to base out, and with the good news coming out of the Fed with the relative to the jobs creation report, the economy is slowing, but it's slowing nice and easy, and it's a perfect scenario for the Fed. And now they're talking about reducing interest rates by June of 2024. And folks, time is passing really fast, so we may see that before we know it. So next summer, they're thinking that the Federal Reserve has stopped raising interest rates, and that they will begin to decrease the interest rates, because don't forget, our federal budget is very, very big, and an increase in interest rates really hurt our pocketbooks as taxpayers. So anyway, we're looking at this stock, going up back to previous highs over the next year and a half or so. So folks, we had a pretty good week this week after the week before, which was absolutely horrible. So you go out, you have a good weekend, you take your mind off the market, and you can watch the sunrise on the Atlantic beach over here. And if you could see a little ship over there under that sunrise over there. And folks, it's really going to be hopefully a nice weekend. So take your mind off the market, because guess what? It'll be back here on Monday, and so will we. So have a good weekend, folks, and stay safe.